Welcome to our series on government securities. Today, we're exploring Treasury bills, which are short-term government borrowing instruments. Treasury bills, commonly known as T-bills, represent one of the safest investment options available in the financial market. They play a crucial role in government financing and offer investors a secure way to park their funds for short periods. Treasury bills are short-term debt instruments issued by the government to raise funds quickly. The maturity period for these instruments ranges from a few days to 1 year maximum. What makes T-bills unique is that they are issued at a discount to their face value. This means investors pay less than the face value when purchasing and receive the full face value at maturity. The difference between the purchase price and face value represents the investor's return. These are considered zero-risk investments because they carry the full backing and guarantee of the government. In India, Treasury bills are available in 3 standard maturity periods. The first is the 91-day T-bill, which matures in approximately 3 months. The second option is the 182-day T-bill, offering a 6-month maturity period. Finally, there's the 364-day T-bill, which has a maturity of nearly 1 year. Investors can choose the tenure that best matches their liquidity needs and investment goals. Let's understand how Treasury bills work with a simple example. Suppose a T-bill has a face value of Rs 1 lakh. An investor purchases this T-bill at a discounted price of Rs 98,500. When the T-bill matures, the investor receives the full face value of Rs 1 lakh. The difference of Rs 1,500 is the investor's return or profit. This discount amount represents the interest earned, even though T-bills don't pay explicit interest like traditional bonds. Treasury bills come with several important features. First, they carry zero risk as they are backed by the government's sovereign guarantee, making default virtually impossible. Second, they offer high liquidity, meaning they can be easily bought and sold in the secondary market before maturity. Third, unlike traditional bonds, T-bills don't pay periodic interest. Instead, returns come entirely from the discount pricing mechanism. Finally, they have a low entry barrier with a minimum investment requirement of just Rs 25,000, making them accessible to retail investors. Treasury bills are open to a wide range of investors. Individual retail investors and citizens can directly invest in T-bills through primary auctions or the secondary market. Institutional investors, including banks, insurance companies, and mutual funds, are major participants in the T-bill market. They use these instruments for managing their short-term liquidity and regulatory reserve requirements. Foreign investors are also permitted to invest in Treasury bills, subject to applicable regulatory guidelines and limits set by the Reserve Bank of India. Investing in Treasury bills offers multiple benefits. The primary advantage is safety, as the sovereign guarantee completely eliminates default risk, making it the safest investment option available. Quick access to funds is another benefit, since the short maturity period ensures investors can get their money back within a year or less. T-bills provide predictable returns because the exact return amount is known at the time of purchase. Additionally, they offer flexibility with multiple tenure options, allowing investors to match their investment horizon with their financial goals and liquidity needs. To summarize, Treasury bills are the safest short-term investment option in the market, offering guaranteed returns with absolutely zero default risk. They are ideal for parking surplus funds temporarily when safety and liquidity are more important than maximizing returns. T-bills are perfect for conservative investors, those managing short-term cash flows, or anyone seeking a risk-free place to invest their money for periods ranging from 3 months to 1 year. Remember, while returns may be modest compared to other investment options, the complete absence of risk makes Treasury bills an essential component of a diversified investment portfolio.
If you like this video, hit that like button and don't forget to subscribe. Visit codelucky.com for more such useful content.